Hello, for those who have joined in. We are waiting for 2 more minutes to see if anyone else joins and then we can start with our session today. Thank you for joining in. Hello, all. For those who have joined, thank you so much for joining this live session. And this today's session is mainly around the topic which is most looked out for when you are starting your investment journey. This is regarding to your mutual fund investments. So generally what happens is people look out for friends advice or through internet, Instagram, which mutual fund they should be investing it without actually researching about it or without actually thinking about why are they investing in this particular mutual fund. So in today's session, I'll try to cover all the topics. If in case something is left out, I'll release it via email or through my Instagram account. So starting with the today's session. So first of all, whenever we look out for a mutual fund, there are certain categories which you should be aware about. Like categories are based on maturity period, principal amount, asset allocation, and so on. So when I say maturity period, it could be an open ended mutual fund or a close ended mutual fund. When I say based on principal investment method, it could be an equity fund, debt fund, or a hybrid fund. Now, how would you select which mutual fund is basically suiting your investment habits? So, for selecting any mutual fund, let's say an example of an equity fund. Equity fund are generally recommended to the people who are ready to take higher risk. Let's say you are able to take losses for more than like 20 or 30%, then equity fund is certainly the best suited for you because this involves high risk and certainly gives you high return over the period of time. Then next is the debt fund. Debt fund is some for somebody who likes passive income, who does not want to take a risk and is willing to give up only minimal amount of capital as losses. So certainly debt fund would be suitable for them. Now, um, while we talk about equity fund and debt fund, there are certainly various mutual fund agencies or mutual fund houses which give out these mutual funds. Like there would be Kotak Bank, which will give out you equity funds. There would be Axis Bank, then SBI Bank, or maybe Parag Parik Fund. Now, how would you select your mutual fund and from which mutual fund house? This is where it gets very tricky for most of the cases. Now, the basic rule to select the right mutual fund is basically based on the performance of the mutual fund. So, let's say if a mutual fund house is performing really well, delivering over, let's say, 10% return year on year, then certainly that is something which you should look out for. But 10% is for the people who want to invest for less than 1 year. If you want to invest in a mutual fund for a long term, then certainly you should look out for 3 to 5 years of returns. Then, next, which we generally look out for is the fund manager. So, the fund manager should have a history of managing assets over a crore when you try to invest, because that shows how credible that particular mutual fund manager is. The third and the most important criteria is fees. So let's say there are multiple types of fees involved when you invest in a mutual fund. The basic one is the entry and exit load. So, entry and exit load are basically the charges that you pay whenever you enroll for a mutual fund and when you exit for a mutual fund. So, when you are investing in a mutual fund, you will have to pay an entry load, and when you exit a mutual fund, you'll have to pay an exit load. Now, if this entry and exit load is higher, this is going to impact your returns. So let's say for example there are three different types of mutual fund, and these three different types of mutual fund have different percentages of exit and entry load. So one mutual fund house has 0.5 percentage, second one has 1%, and third one has 1.5 percentage. Now in this case, 0.5 percentage entry and exit load fund is certainly very well suited because the amount of charges you are going to pay when you enter a mutual fund, that means when you invest in a mutual fund, and when you exit a mutual fund, is very low as compared to the charges that you're going to pay when you pay 1.5 percentage of the entry and exit load. That's certainly the most highest. uh, these entry and exit load can go as high as 2 percentage, not more than that. So this were the charges of the mutual fund. The next one is the tax implication. Now in case of tax, what happens is it depends on your period of investment. So let's say if you're investing for a short period. When I say short period, it means less than 1 year. And when I say long period, long term, it means more than 1 year. So this taxes are so how does this taxes work? So if you're investing for less than 1 year, your tax would be just 15 percentage. And if you are investing for more than 1 year, say you stayed invested in a mutual fund for 2 years, then your tax would be 10 percentage above 1 lakh. So here you get a deduction of 1 lakh on your investment. But this tax system is different for different category of fund. This 15% and 10% is for equity fund, but if you invest in a debt fund, this would be different. This would be as per your income tax slab. So whatever amount you are getting from your mutual fund, that will be added to your income tax slab, income, and that would be taxed as per the income tax slab. Basically your normal individual tax system. The next one is the long term debt funds when you invest for more than 3 years. Here it is different as compared to the equity fund. So in equity fund, long term is like more than 1 year, but in debt funds, it's 3 years. So if it is more than 3 years, then it is taxed at 20 percentage. So more or less, this is how the taxation of mutual fund works. Now the another question that generally arises when you think of mutual fund is, should I go for SIP or should I go for a normal lump sum mutual fund investment? So, how would you evaluate that? A simple method is you should think about, do you have the money to invest in lump sum right now? Let's say if you want to do an investment of 1 lakh. So, if you are investing 1 lakh in mutual fund, do you have amount in your bank account to meet your expenses? If you do, then you can go for a lump sum amount. If not, then you can start small with an SIP. Your SIP can be as low as 1000 per month. And in some cases, if the fund manager is big, they also love 500 per month SIPs for a new investor. So certainly SIP is well suited irrespective of whether you have amount in your bank account or you don't. So this is a case of whether you should go for an SIP or you should go for a normal mutual fund. Then the third category, which is kind of coming into focus these days, is the STP, which is the setup SIP, systematic transfer plan. Now this systematic transfer plan SIP, what it does, it say, let's for example you have invested in an equity mutual fund and then you want to also invest in debt mutual fund, but at this moment you only have certain amount which you want to invest. So you invest 100 rupees in equity mutual fund and then transfer 10 rupees every month to debt mutual fund. What happens is your outflow is 100 rupees every month and then 10 rupees is being allocated to another fund. This allocation, this transfer of 10 rupees is known as the systematic transfer plan, which means you are allocating some amount from your existing fund to a different fund. Now, while we have spoken about which mutual funds, which are the different categories of mutual funds, and what are the different ways in which you can invest, which is lump sum or through an SIP or through a systematic transfer plan, if that suits your risk appetite. But how would you select which mutual fund you have to invest in? So there is a website which is called as Rupee West. I'll just drop that link in the chat box. Give me a moment. I'll just add that link. So if you go to Rupee West website, they will have a feature. They will have a feature which is called as um, mutual fund comparison. So this mutual fund comparison, what it does is it will compare two different types of mutual funds for you and tell you which one is best in terms of how much you want to invest and for what time period. So this is the link which is now, for some reason I can't text it on the group, but if you could just Google Rupee West Mutual Fund Comparison, then certainly you can find that uh, that tool which I am referring to. So I personally use that tool for myself when I have to invest in a mutual fund and I'm not sure which one I should be using. And that gives me a comparison about what is the fees, what is the entry and exit load, how much is the fund manager managing, and what is the rating of that mutual fund. So rating of that mutual fund also impacts the quality and the returns. So these ratings are given to each mutual fund based on how much they have performed in the past 3 to 4 years. Rupee West Mutual Fund Comparison. Yep. So you can check this out and use it. If you guys have any questions so far, just drop it in the chat below and I'll try to cover it. Otherwise, we'll move on to the next concept. Well, there seem to be no questions at the moment. So, moving on to the next topic that we have is the key factors to look after when you are thinking of investing in a mutual fund. So, whenever you are planning to invest in a mutual fund, um, these investments these investments are based on different factors like risk appetite. So, when I talk about risk appetite, you could be an aggressive investor or you could be a very laid back investor. So, depending on what your category is, your investment should go towards that way. So when I talk about being an aggressive investor, that means if you want to risk 20 percentage of your investment amount, then at least 20%, then you are an aggressive investor. And this aggressive investor should mainly look out for equity funds, because equity funds have a history of giving more than 15 percentage returns year on year. And at times, if the market is responding very well, like in today's time, then these returns can go as high as 30% as well. So certainly one. Then second one is if you are looking for some tax benefit. So in case if you want any tax concessions like under ATC or any other section, then you can look out for ELSS schemes. So ELSS schemes are made for these tax benefit. One of the most talked about mutual fund in this category is the Parag Parak mutual fund. They are known to deliver over 30 percentage return year on year, and this is something that I have personally invested in, and I can totally vouch for that they have been very consistent with their returns year on year. Certainly this return, the XIRR goes down after 2 or 3 years, like it goes down to 15-20 percentage, but it certainly is the most highest delivering um, mutual fund in this particular category. Then the third category is the debt fund. Like I said, if you are laid back, if you don't want to take risks, or if you don't want to give up much amount of your capital, then certainly debt funds are the best suited uh, for your investment category. And the other one is the index fund. So index funds are gen so index funds are basically you are investing in Nifty 50 or Nifty 100 or BSE 100, these kind of buckets that you already have in the market. You are directly investing in them through these mutual funds. So if you want to directly invest in these index, then certainly these mutual funds are the best suited for you. Yep. Uh, So, the next and the last topic that I want to touch base upon is the asset allocation. So, what happens in asset allocation is, let's say, for example, you do have some money in your bank account that you wish to invest, but you don't want to go all in on equity funds and risk your capitals. In that case, you do an asset allocation. So, for any new investor, the common advice is that you bifurcate your funds between equity and debt. So let's say, for example, you have 100 rupees in your saving account. Invest 20 rupees in equity fund, 20 in debt fund, 10 in some other funds that you want. Let's say if you want to invest in gold schemes or in gold directly, you can do that. So basically, these categorization that you do based on the amount that is available with you, that is called as asset allocation. A very basic allocation, if I have to talk about, is just allocate, let's say you want to invest 50 rupees in a mutual fund, just divide it into equal portion, say 10 for equity, 10 for debt, 10 for ELSs, and then remaining 20 in some gold or any other schemes. By this way you are giving equal weights to all of your fund categories. Let's say you want return, let's say you want a return on your equity fund, you want a return on your debt fund. So by this, what you are doing is you are equally segregating your fund that is available. But let's say you want to go heavy on your equity funds, then you can do is, out of that 50 rupees you can invest 30 rupees in equity schemes, and then 10 rupees in debt fund, and then remaining 10 rupees in some index fund. That way you are going aggressive on your equity funds. And if you are laid back, you can do just a reverse of this. You can invest 30 in debt, 10 in equity, and 10 in index fund. So, this, what I did just now of that 50 rupees, is basically the asset allocation that you focus on. I am getting some questions in the comments below. It says, what is the difference between normal equity fund and ELSs? So, first of all, like I said, ELS, so there are three, four different categories of fund. One is the equity fund, then there is debt fund, then there is ELSS fund and index fund and so on. So equity fund is basically a fund which is aggressive on equity investments. They'll invest in all the shares that you are looking at, Tata, Reliance, it could be large cap, mid cap, small caps. So they directly invest in a portfolio of such stocks. The second one is ELSS. What happens in ELSS is it is a tax saving scheme. So this ELSS won't be that aggressive. It would be mild one, and it does invest in equity shares, let's say, but it would invest in shares of large cap so that the risk is minimal. So this is primarily the basic difference. So here the major difference between ELSS and equity fund is the risk. Equity fund will have high percentage of risk, while ELSs are basically investment in equity but with low risk, and plus it would give you a tax benefit. Yes, it does have a lock-in period of 3 years. So what happens in equity ELSs is, um, since you are getting that deduction in tax, you are getting that tax benefit. So there is a lock-in period of 3 years so that you don't withdraw your amount. And if you withdraw your amount, it would be taxed at a normal percentage that I specified, like 15% and 10 percentage, depending on the period that you're holding. But if you hold it till the lock-in period, there will be no tax. It's tax free. So yeah, I have covered mostly all my points. In case if you've got any more questions, just drop it in the comments below. And don't forget to check out the Rupee West Mutual Fund comparison tool. It is something that I personally use, and it gives a very nice comparison of mutual funds that are there in the market. Let's say if you just type in equity there, it will show you the list of equity funds that are available, and you can compare like 3 4 mutual funds on the side and see which one is better. So at this moment within equity fund, the energy segment is more lucrative because of the government schemes and everything that are coming up. Um, but yeah, um, I think it's the energy segment and the cement segment. These two are the most lucrative one at the moment, if you ask me. Defense segment is overhyped. Currently, all the segments are overhyped because of the market boom that we are facing. But um, but yeah, defense certainly has some scope at the moment, not a lot. But yeah. I also have a question difference between mutual fund and ETF, please. So mutual funds are more actively monitored, and the ETFs are something which is not actively monitored. So ETF will include index funds, exchange, like basic index funds, and these index funds are something that if you have invested now, after 1 year, it will still be the same. The allocation of stocks or allocation of index won't change. But in a normal mutual fund, what happens is they have a portfolio of say 20 stocks. Now this allocation of 20 stocks, they might change it after 6 months, they might change it after 8 months and so on. But yeah, the major difference is active management and passive management. If you guys have any other questions, just drop it in the comment section below. I'll try to cover it. Otherwise, I think we are good for today's session. Okay, guys, I think we have reached to the end of the session. And in case if you have any more questions, don't forget to drop it in the comment section. I'll try to respond to it um, as early as possible. But yeah, thank you so much for joining. See you later. Bye.